Each year, Microsoft Research hosts hundreds of influential speakers from around the world, including leading scientists, renowned experts in technology, book authors, and leading academics, and makes videos of these lectures freely available.
Okay. And we really should be outside, but since you all insisted on showing up, we have to go through with this now. So I'm going to talk about two separate pieces of work. If I'm lucky, I'll talk about one of them with roughly 2/3 of the time and have a third of the time to summarize the other one. If I'm unlucky, we'll only cover the first one. And if I'm really unlucky, we won't even cover that, but I think I should be able to get through at least the first one. And these are on pieces of work I did really on problems in quantitative finance, in computational finance. And the first one especially has a strongly algorithmic flavor. Let me make a couple of, and I know that people's background about financial markets and different aspects of quantitative trading probably vary greatly. So I'll try to make everything as self-contained as possible, even if I need to kind of overview some things quickly. But just to explain a little bit the origins of this kind of work, which in many ways, at least the problems I'm looking at, are very representative of the kinds of things that people would think of on Wall Street or in quantitative finance more generally. Of course, in trading, such as as might be done by a quantitative hedge fund, the most financially important decision that a hedge fund manager makes, or equivalently the automated strategy that a quantitative hedge fund manager is overseeing, is always the decision about whether to buy or sell shares of a particular stock, whether to go long or short the stock. That, of course, is the most important decision that these people have to make, because that's what determines the returns and profits that they generate. But a lot of the most scientifically interesting problems in quantitative finance actually only start once you've made the decision to buy or sell a particular volume of a certain amount of stock. And this is the field that, at least on Wall Street, is known as algorithmic trading. So algorithmic trading has technical meaning on Wall Street, even if it doesn't in the press. Algorithmic trading doesn't mean anything combining computers and trading. It means specifically once some party, whether it be human or machine, has decided, I want to buy 100,000 shares of Microsoft stock sometime between the market open and the market close today, how do you optimally execute that trade? And optimally executing that trade generally means dividing that trade up over a number of dimensions. So one dimension might, of course, be time. If you have a large trade that you want to execute, for reasons of market impact, it doesn't make sense to try to do it in too short a period of time. But as you'll see in the first part of this talk, another major decision that's arisen relatively recently is which exchanges to execute that trade in. Because there are now multiple competing exchanges in any given stock. So for instance, it used to be that to trade New York Stock, NYSE listed stocks or NASDAQ listed stocks, you had to execute your trade through those exchanges and nowhere else, which are known as the primary exchanges. But now there are all kinds of independent third-party exchanges where you can go trade NASDAQ stock with counterparties. And so you have this fragmentation of liquidity, as they call it in finance, and you have the opportunity to benefit from that fragmentation of liquidity by not only breaking up your trade over time, but also breaking it up over multiple different exchanges. Okay? And so a lot of the most interesting science in quantitative trading comes after you've already made the decision to buy or sell shares of a given stock, and where you actually want to realize the execution in the most cost-effective way. Okay, so that's really the topic of this first talk, which I did relatively recently with several collaborators, but including I have this alter sort of ego or life on Wall Street, where I do work with a well-known hedge fund in New York called SAC Capital, and my partner there is an old colleague of mine named Yuriy Nevmyvaka. So let me first give a little bit of background about how modern equity exchanges work. So modern electronic exchanges for equities, like Microsoft stock, for instance, are sometimes what are called lit or light exchanges, in contrast to the topic of this first part of the talk. And basically by light you mean that there's complete transparency. So imagine, God forbid, that in Ad Center, advertisers who wanted to bid on a particular keyword could see exactly what all of the prices of the other advertisers were in real time. Okay? Basically, that's what modern equity exchanges are actually like. Okay? And basically, the standard mechanism for implementing stock exchanges for modern equities is basically a continuous double auction implemented by a limit order book. Okay, so here, if you can read it, is actually a screenshot. This is rather old by now, which you can tell not actually by the share price, but by the fact that there's decimalization involved now that's no longer allowed, but that's not important. So this is an actual real-time snapshot of an order book for Microsoft shares some number of years ago. And it consists of two lines or queues, if you like. Basically, there's a buy side and there's a sell side. And the buy side, by definition, is sorted by price in descending order. And the sell side is sorted by price in ascending order. So here you have a party at the top of the buy book who wants to buy up to 1,000 shares of Microsoft stock at $23.76 or lower. Okay, they'll always be happy to settle for a lower price. Here's somebody who wants to currently buy 3,087 shares, who's just a penny behind them at $23.76, and it goes on down from there. So it's sorted by price, and you can see that this is rather early in the day. This is even before the market's opened. There are a couple hundred more orders down, so the book is very deep in this particular stock. It's a highly liquid stock. Okay. Similarly, on the sell side, you have a party that wants to sell 100 shares for $23.78 or more. Okay, they'd always be happy to sell for a larger amount. And this is the price at the top of the buy book is often called the bid. The price at the top of the sell book is often called the ask. And so by definition, there is always a gap or the so-called spread between the bid and the ask, right? The price being demanded by the most competitive buyer is lower than the price being offered by the most competitive seller. And so then how do trades get executed? Well, trades get executed by other parties coming into this picture, crossing the spread and eating shares on the other side. So if somebody came in and basically said, well, I want to buy 2,000 shares, for instance, and I'm willing to pay up to $24 a share, they would first get 100 shares at $23.78. They would get their next 800 shares at $23.79. They would get the next 500 shares at $23.80, so on and so forth, until they basically had consumed their 2,000 shares, and then the books, there'd be a new ask at the top of the book, so on and so forth. Okay?
When you say by definition there's a gap, you mean they'd never enter the book if the trade could be executed?
That's right. So as soon as a marketable order comes in, as soon as a market that comes in that's immediately executable, it gets executed as long as there's liquidity on the other side. Okay. And then it could be that order isn't fully executed and becomes the new bid. It's sort of sitting there waiting now. Okay? So that's why it's by definition of the way the mechanism works. Yes?
So once the bid has been made, can a person retract the bid?
So basically, any order that you put in prior to execution can be withdrawn, can be canceled, okay, including orders that have been partially executed. So if I put in an order for 1,000 shares and 250 get executed, I can then withdraw the remaining 750 anytime up until execution. Once executions happen, you're in. Okay? Yes?
When you say fully transparent, it's still anonymous, isn't it? Or is this not anonymous?
Yes. So it's anonymous in that you don't know the identity of the actual parties, of course. That's too much, right? Yeah. But it's transparent in the sense that basically you can buy for not very much money data feeds that in every one of the 6,000 publicly traded U.S. equities, you can reconstruct this picture in real time. Yeah. Okay? It's tedious and it's a lot of data, but you can do it. Okay? Okay, so the reason I go through this is because even though I won't be talking about exactly this kind of exchange, it's interesting to contrast with it. And you also see one of the things that's meant by market impact, right? So if I come in and if I come into this picture and say, I need to buy 100,000 shares of Microsoft stock right now, I can do it, right, by sort of offering an arbitrarily high price, but I'm going to get successively worse prices the deeper I eat into the opposing book, right? And as if I get deep enough, I might be sort of paying far, far above market price, sort of what the current, what the price of the last trade was, okay? So that's what I would call kind of a mechanical aspect of market impact. And then there's the one that you can't really ever know or measure, which is, well, and then once I do that, everybody else will see that there's some party out there desperate to buy shares of Microsoft stock, and maybe they will actually then change their subsequent trading behavior to take advantage of me. Okay? Okay. So, so there are many advantages that I'm not going to go through, some having to do with sort of quantitative aspects of trading. It's great to have this kind of data. This is what's often called sort of market microstructure data. It's kind of the finest granularity of financial data. So if you're a high-frequency trading firm, which we might eventually discuss towards the end of the talk, there's all kinds of interesting things you can try to do with this sort of very, very microscopic data. And it also, there are advantages to this kind of mechanism just in terms of the transparency and the fact that you know it's very clear why if you go back and look at the data, it's very clear why your order did or didn't get executed. Right? There are not these sort of days where, good old boys on the floor of the stock exchange would, run in front of your order. So these things used to happen where you wanted to buy 100,000 shares of Microsoft stock, you had to call it into a broker on the floor of the New York Stock Exchange, and they might literally say, well, since I know that they're going to need to be buying these shares over the course of the day, maybe I'll just buy some shares in the morning now, wait for them to push the price up, and then sell them back to them at the end of the day. This is a time-honored illegal tradition on Wall Street known as front-running. Okay? So it's very difficult to front-run in an automated market where there's basically a record of exactly what the books look like at every second and where your order was in regard to that order flow and stream. Okay. There are disadvantages to it, though, and in particular, the disadvantage is the scenario I've been implicitly talking about so far, where some party wants to trade an extraordinarily large volume of stock in a very short amount of time. Because if you try to do it in this kind of open, transparent exchange, it's inevitable that you will have both of the types of market impact that I described, the mechanical one and the sort of more counterfactual or psychological one. And you can go, if you trade, you are painfully aware of this because you can measure, of course, all kinds of things where, how much was the movement of the price of the future price of a stock conditioned on my having traded in it versus conditioned on my not trading in it. And basically, it's inevitably the case that the mere fact that you traded in a stock causes its price to move against you. Okay? And so you'd like to minimize this. And you'd like to minimize this if you're a very large hedge fund. You might, just to put some numbers on it, it would not be unusual for a single large quantitative hedge fund to contemplate within a short period of time, like days or a week, to take a position in a company like Microsoft that might constitute a non-trivial fraction of the total outstanding shares, right? So a firm like mine, SAC, might contemplate getting into a position where they were, a single-digit percentage shareholder of all the outstanding shares of Microsoft stock in a relatively short period of time, and that's going to be a very, very large fraction of the trading volume. So if you try to engage in such a transaction and you're not smart about it, you will lose serious amounts of money by doing it poorly. Okay? Okay. Luckily, we are in a time of, or luckily or unluckily, depending on your point of view, which often falls along the lines of whether you're a trader or a regulator or a sort of mom and pop retail E-Trade type of trader. We are in a period of great innovation in financial markets and exchanges, by which I mean there's been a lot of proposals and implementations recently of different types of exchanges, different than the one I'm going to describe here. And the focus of this first part of the talk is on one of them, which is known as dark pools. Okay? So dark pools are basically meant to address exactly this problem that I've mentioned. And more specifically, just suppose that I'm trying to buy 100,000 shares of Microsoft stock in a relatively short period of time, at the same time that there's another party out there who more or less wants to short Microsoft stock for roughly the same volume. Okay? So right now, the problem is we'd have to kind of discover each other through this mechanism, and we would probably both suffer as a result of this, right? It would basically become implicit public information that there were two parties, one of whom wants to buy a lot, another who wants to sell a lot, and I won't go into the details of how you would do it, but if you sort of knew that, there are many, many ways that you could profit from the existence of these two parties. What we'd really like is kind of like a private agent, and this is exactly what dark pools are meant to replace. There used to be people, there are brokers on Wall Street who serve this function, where if you've If you've got a difficult trade, meaning usually a lot of volume in a short period of time, you would call up a broker, right, at a place like Morgan Stanley or Goldman Sachs, and you'd say, hey, I want to get into this big Microsoft position, long or short, but it's obviously too big. And then they basically try to quietly shop it around the street. They would call up other brokers and say, well, do you happen to, nobody's done any trading yet, right? It's all between humans. And you're trying to find a match, right? The brokers are trying to find a match between these two large parties who will then execute the trade away from this exchange, which is legal. The trade eventually has to be cleared and will, after the close of the market, will appear. Okay, and let me just point out something else, is that when you're trying to do such a large trade like this, you're not really concerned with what I would call price improvement. You'd be perfectly happy, for instance, to buy your 100,000 shares of Microsoft at the midpoint between the current bid and the ask. In fact, that would be great, right? So that's unlike the parties way down in this book, right? Like, who is this fellow, who is hoping to get shares of Microsoft stock fully 12 cents away from where it's trading right now, right? So this is somebody who either is hoping to get lucky, or they have a model which is telling them that Microsoft is worth it at this price but not above that price, and so they're going to sit there, and if they don't get executed, it's fine. If, on the other hand, you really want to get into the trade, you'd be perfectly happy to take the midpoint between the bid and the ask in the current market. Okay, so the way these deals might be struck might be something like that. We might say, well, we agree that we're going to basically trade positions in Microsoft stock, and we'll do it at the end of the day, and the price will basically be whatever the average price of the stock was over the course of the day, or maybe what the closing price was, so on and so forth. Okay, so there is a new type of exchange called dark pools, which are essentially meant to implement this kind of back alley matching mechanism. Okay, so these are again electronic exchanges. There is again a line of buyers and there's a line of sellers, but there's two differences compared to the picture I'm showing you here. One is that you don't get to see that line at all. Okay, it's dark to you. It's not transparent, and furthermore, there are no prices associated with on the line at all. Okay, so the ordering of the parties on the buy and the sell sides are basically just by order of arrival. Okay, and then you have whatever the volumes the parties want are, and as long as neither queue is empty, you just keep matching arriving buyers and sellers with each other, and it's agreed that when an execution takes place, the price of that trade trade clears at will be the midpoint of the visible market, of the lit market. Okay. So the goal here is to kind of get something close to the current market price without having any market impact because you have a very large trade. Okay? So do people understand the mechanism here? Okay. And so by definition in a dark pool, it will typically be the case, right? If you're trading in a dark pool, your experience will be either there are parties on the other side or there are not. As long as there are parties on the other side, your trade is sort of instantaneous. And then there are these periods where there's only orders on one side of the market awaiting the arrival of a counterparty from the other side. Yeah, Pushmi.
So the party has no control over the price that he or she is going to pay. So if I am a buyer of Microsoft stock, it makes total sense for me to actually go to the electronic exchange and do a lot of shorting so that the price goes down on the open market, and then when the execution happens in the dark pool, I get a low. Okay,
good. And there are concerns with all sorts of these kinds of cross-exchange gaming or arbitrage opportunities. So I would say there's sort of a two-part summary to think questions like that. One is that there are fears that people do this kind of thing and that therefore it's a bad idea to trade in dark pools, etc. But B, these things aren't as easy as they would seem, right? So in particular, your idea that I should go to the light pool and sort of first move the price there, well, to do that, I have to trade in the light pool, right? And to move the price a lot, I might have to trade actually a lot to move the price enough to make it that I could profit from it in the dark pool. And so, it's not like these things don't happen, but it requires quite a bit of technology. And you have to worry about connectivity and latency and things like this, but it happens.
That's quite legal.
Okay. Okay. Some things are obviously illegal. Other things are in a gray area, right? And I mean, as an aside, Again, it doesn't really matter if I finish this talk. I rarely do, because people are interested in these sort of these higher level questions, which I'm happy to answer. Part of the difficulty with law in these areas is that a lot of it is based on intent, right? So, the same pattern of trading behavior could be legal if you were legitimately trying to get into some position that you wanted to hold, versus you were merely doing it to manipulate other people's behavior or sort of coax them into doing something, right? And so what's difficult here is that, the law might be clear that if your intent is to manipulate the market, then it's illegal. But if you were really trying to get in, but how can you tell, right? It's impossible to tell. Although if these cases go far enough, then of course you actually get code. And one of the things that's interesting about the modern era in trading is that if before I was a trader and you sort of saw my trading pattern and there was both a benign and a manipulative explanation for it, there's nothing you can do to go further than what the data says. But once I've written a piece of code, you might actually be able to look at that code and say, the intent of this code is obviously to manipulate, not to get into positions. Okay. So, on this point, there's lots of controversy over all these different types of new mechanisms, including dark pools. Here's Mary Shapiro, the head of the SAC, looking appropriately disgusted over the notion of dark pools in a recent Wall Street Journal article. Nevertheless, these exchanges do serve kind of an economic purpose for trading parties in many situations. And so they proliferated. And so the last time I checked, there were something in the US, there were about 40 independent dark pools in major, equities that you could, avail of their services. There are something like half of that number in the UK alone. And so now you have this interesting problem, which is not only do you have to decide, should I send my orders to the light pool or the dark pool or some mixture thereof, but now even if I'm just going to send the flow that I'm sending to the dark pools, I have to ask, which of these 40 pools should I send it to, or how should I break it up, and are some of them better than others? By the way, for both real purposes and for marketing purposes, a lot of these exchanges will claim to specialize in particular types of stocks. So it's like, if you're trading high volumes in mid-cap technology stocks, we're the dark pool for you, okay? And, in all kinds of exchanges, right? I mean, it's the same in sponsored search, right? Liquidity begats liquidity. The more advertisers these two-sided market effects, right? The more advertisers you have and the more end users you have, the better job of a matching you can do between sponsored ads and end users. And so then more advertisers want to join your platform, for instance. So it's the same thing in stock exchanges, right? The more people it's like a nightclub, right? I mean, the more people that are going to the nightclub, by definition, the more attractive the nightclub becomes. So it's the same thing in dark pools, and so they'll often try to use tricks. I mean, sort of saying something like, we specialize in mid-cap tech. In fact, you might even encourage mid-cap technology stocks, people to trade there by giving discounts on the fees that you charge, things like this. It's very analogous to like a ladies' night at a bar or something like this. You want to get some counterparty in, which will then attract the other counterparty. Okay, so it's a hard problem to do this, what's called sort of smart order routing. So now let me move to a little bit of formalization here and define a specific algorithmic problem that I'm going to then describe a solution to. So imagine that we're some brokerage that wants to implement an algorithm that will take incoming orders from clients, maybe hedge funds, mutual funds, money managers, the like, and sort of say, well, I'm going to take this order and I'm going to send it to the dark pools, but here's how I'm going to break it up over these 40 different dark pools, okay? So we're given a sequence or maybe some probability distribution of arriving client or parent orders, and we want to know how should we disperse or break up these volumes, these arriving order sizes over a large number of dark pools. And this is basically a particular case of the problem that's known on Wall Street or in finance generally. When I say Wall Street, I realize this is an American bias, but when I say Wall Street, just replace Wall Street / the city / all the other major exchanges. But this is sort of a special instance of what's often called smart order routing. How, given the decision to buy this many shares of Microsoft, how should you break up the order over these many different competing exchanges? And of course, you have to do this in the absence of much initial knowledge. We may initially know very little about the relative qualities or properties of these pools, and we have to basically learn about them over time, right? And of course, how we should break up for the reasons I've already mentioned, including sort of liquidity and specialization of the exchanges, it really might depend on the particular stock, its volatility, how liquid it is, so on and so forth. Okay.
Is it public knowledge which dark pools actually executed which trades at which times?
Yes,
So,
because
so you have got a lot of data about that, in fact, past history.
okay, no, so what's public is any trade that actually gets executed has to eventually be, as they call, printed, right? It has to be cleared, and so you'll see, this trade occurred at this price.
But not which pool.
I don't know if you can learn which pool. I'm not aware of the availability of that data at this point. So right now, in my experience, which includes, basically solving this problem for a large bank, the data that we had available was only our own trading within those dark pools, okay, which has its own problems, of course, because it's a biased sample. Okay, so I'm going to introduce kind of a theoretical model, and to simplify this problem and be able to talk about it more technically, I'm going to make some simplifying assumptions. So I'm going to, first of all, without loss of generality, assume that we're talking about a single stock and that we're talking about all of the incoming orders being on one side of the market, let's say orders to buy shares, and selling is completely symmetric, okay? So that's without loss of generality. A more toxic assumption is that each dark pool basically has a distribution of what liquidity is available on the other side of the market at any given moment in time, and that basically my executions will be made against IID draws from that available volume in a way that I'll detail very shortly, okay? But what I'm really saying here is that I'm assuming that the given statistical properties of a particular pool are static. It might differ wildly between pools, but it's static within a pool, okay? So this is definitely a non-trivial assumption, but all of these assumptions can be relaxed in various ways at some cost of complexity, and I'm going to ignore them. I can talk about them at the end, but I'm mainly going to ignore them in this talk because, as you'll see, there's enough to say about this simplified version of the problem. Yeah?
So what's the objective, Michael? I mean, the problem does not have an objective. What are we trying to do?
I'm going to give you an objective, but looking ahead, so the result I'm going to describe to you is actually invariant to a fairly wide range of objectives, but the objective that I'm going to look at basically wants to, at each step, maximize the expected fraction of the remaining order that's executed, okay? But I'll talk about alternatives. Okay, and so what I'm hoping to summarize here are first of all, a theoretical framework filling in the details of what I just said, and then an algorithm for solving this problem and sort of a proof of its performance and analysis, and maybe a little bit of empirical validation. Okay, so let me talk about the theoretical framework and algorithm. Okay, so to sort of say a little bit more about my static statistical assumptions about each pool. So suppose we have whenever you see venue here, think dark pool. Venue is finance parlance for an exchange generally. So let's imagine that we're just concentrating on a single dark pool. How am I going to model that dark pool? So again, I'm assuming here that all of our orders are buy orders. And so what I'm going to assume is that there's some probability distribution over the number of shares that are available at a given moment. So I'm going to kind of imagine a discrete time model where at each time step I can decide how many shares to submit to this dark pool, okay? And then what happens is that we basically draw a value from this probability distribution over how many shares at that moment are available on the opposite side of the market, the sell side of the market. And then how many will get executed? Well, it depends on the relationship between my submission and the value drawn. So more precisely, if I submit V shares to this pool at time t, then we draw a value S from this probability distribution. And then the number of shares that actually gets executed, of course, is the minimum between what I submitted and what I was available. Okay? So if I submit 1,000 shares and 500 were available, so V is 1,000, S is 500, then 500 get executed. And of course, note that in that case, that I know that exactly 500 shares were available for me at that time step. If on the other hand I submitted 1,000 and 10,000 were available, then 1,000 will get executed, my full order, but now I won't know how many were actually available to me. Okay? So this is what they call in statistics censored observations. They're censored on one side, right? Because if my submission is below the amount that was available, then it's clipped by the value of my submission. And if my submission is higher than what was available, it's an unbiased draw from the distribution. Okay?
You get to you get to offer you submit your 1,000 shares, and then at the end of the time step, you get to withdraw your submission.
No, so I sort of have a discrete time model. I can break up my order over many steps, but at each step I submit whatever I want to submit, and then instantaneously this happens, and I get back what was, and now anything that was executed, I'm on the hook for.
Yeah, right. But anything you don't execute, you get back again.
That's right.
So, but I thought that's not very pool-like, right? What all the other guys, they have to put their things in and leave them there because if they're leaving.
They're kind of all doing this also. So I'm kind of assuming a model.
So at any time step, they'll sort of arrive and they leave.
Yeah, that's kind of what I'm modeling here, and the sort of the logical extreme to address the drawbacks of that would be kind of a model where. Well, you could have some kind of time series model, or you could just assume that there's sort of some arbitrary sequence of available volume on the other side that's determined by the aggregate behavior of the rest of the market, and that's what I get at each time step. Okay? Okay. So that's sort of the mechanism within a single venue. Of course, the real problem is that there are these many venues. Here I've drawn 4, for example, which might have rather different looking distributions. And how I should break my order up depends not just on the form of these distributions, but on the size of my order, right? So the bigger picture here is that we have some volume V that we want to execute that maybe was just given to us, or it maybe was drawn from some probability distribution over the arriving volumes from our hedge fund client. But then we want to basically break capital V into 4 values that sum to V and submit them to these shares. And of course, the question is, how should we do this, and in service of what goal? Yeah.
So, some to me, I was actually thinking about that problem. Why, it might make sense to actually exceed V.
Yeah. Well, okay. So it certainly might make sense to be lower than V because you might want to do it over several steps. You might get better performance that way. In general, though, you wouldn't find brokerages, at least, ever wanting to exceed V because the client has only asked them for V shares, and so if they submit 10 V and actually get much more than V, then the brokerage is kind of on the book. They're on the hook for the risk of any shares that they got into above V. The client didn't ask them to get that many shares.
Well, it's a trade-off, right? They want to execute in the very first instance all the shares.
Yeah, but I'm saying that basically as a socioeconomic fact of Wall Street, they would never want to take that risk because there's a huge difference between execution risk and position risk, right? The risk that the brokerage wants to take is just the risk of executing the given trade properly. If they exceed the number of shares, now they're like a hedge fund. They're basically holding market risk, and they don't want to hold market risk. They only want to hold execution risk. Okay, so let me first talk about one particular criteria and then some alternative criteria for how you would do this allocation in the case that you knew what the form of these distributions was. So I actually tell you the exact form of these distributions. First of all, what's a reasonable criteria? Okay, so here's a simple theorem that's not difficult to prove. Okay, so suppose that our objective is to so we have some remaining shares from, so we're going to kind of look at this on a step-by-step model. We're not going to do look ahead, right, which is, again, a sensible thing as well. But so suppose our goal is at a given time step to take whatever number of shares we still have to execute and break it up over these 4 or however many exchanges so as to maximize the expected fraction of the shares that we submitted that are actually executed at this time step. So we're in some sense trying to be greedy at each time step and get as much of our order done or filled at that time step as we can in expectation. Okay, so it's not hard to prove that there's a simple and efficient greedy allocation algorithm that's optimal if you know the form of these distributions. And I'll just describe it in English. What you would do is you'd take your V shares and your algorithm would sort of decide on a share-by-share basis which of these exchanges to allocate that next share to. always choosing to allocate that share in which the marginal probability of execution of that share is the highest given the allocations you've made so far. So I take my 1,000 shares and I might say, well, the first share is most likely to be executed here. I take the second share, maybe it's still here, and then at some point it looks better to start allocating shares to the other venues, and I just keep doing this, and that gives you the optimal allocation. Okay? So the rest of the talk, I'm mainly going to act as if this is the criterion in question. But there are many other objectives that you could sensibly imagine as well. So one might be sort of, so here I have really, if you like, an objective function which is linear in the number or fraction of shares I executed. I could also have threshold behavior. I could basically say, no, maximize the probability that all of them get executed at this step. So doing 99% of them is worth nothing to me. I want to get it all done. Okay, and then you would choose a very different allocation. I might also want to have a multi-step objective, like minimize the half-life of the order, the number of steps it takes to reduce the volume by 50%, for instance, or other nonlinear objectives. I haven't thought hard about it. I suspect that actually, even with known distributions, some of these maximization problems, these nonlinear maximization problems, are probably intractable. But it kind of doesn't matter for most of what I'm going to say in this talk, because even though I'll kind of imagine that we're using this one, the learning algorithm that I'm going to give you is really kind of a meta-learning algorithm that basically will give an analogous theorem to the one I'm going to describe for any of these, as long as you give it a black box for doing this offline maximization. So as long as once I know what the distributions are, there's an algorithm that will kind of in unit time return to me what the optimal allocation is, I can use that as a subroutine in the learning algorithm that I'm going to describe to you. Okay, so now we can finally get around to just talking about the learning problem. So, now the picture, the difference between this slide and this slide is now, of course, we initially know nothing about what these venues look like, okay? And so, mercifully, there's not too many ways an algorithm for solving this problem can start out, because you know nothing, almost anything you do is equally good or equally bad as anything else. It probably makes sense to initially just take your order and divide it into 4 equal-sized pieces and start submitting, okay? But then, of course, what happens is that for each one of these exchanges, we'll start observing partial or, we'll start witnessing executions or partial executions as time goes on. And then we're starting to get data back about the relative merits of each distribution, censored data. And so one natural subproblem that arises here is, just given the data that I've seen so far of submissions and executions or partial executions in each exchange, how should I estimate what these distributions look like? And I'll talk about that on the next slide, I believe. And then a natural thing to do, if I have a sensible way of estimating these distributions, here's an idea for an algorithm. I could use an algorithm that, from my current distributional estimates, just assumes that those estimates are correct and computes the optimal allocation given those estimates, okay? In the case of the linear objective function I described using that greedy allocation method. And then, of course, I'll get another round of data from that allocation, which I can then use to update the distributions again. Now, note that there's really a reinforcement learning problem going on here for those of you that are familiar with the reinforcement learning literature. First of all, there's a strong exploration-exploitation trade-off here, right? Because my observations are strongly influenced on the allocations I submit in the first place. So if I never submit 50,000 shares to some venue, I'll never learn how often 50,000 shares were actually available in that venue, okay? Of course, by submitting 50,000 shares to a venue, if that's a very large number, I might run the risk, when every step I do that, of hardly getting, of having submitted a huge fraction of my volume there and getting nothing in return for it. So there's a strong exploration-exploitation trade-off, and so we're working in a state space where our states really are our current distributional estimates, and the number of actions available to us at each state, right, are all of the possible ways we could divide V shares up over all these venues. So both of these spaces are really exponentially large. So if you like, you can think about the algorithm I'm going to describe to you as showing a case of a reinforcement learning problem with a very, very large state space and a very, very large action space, where there is yet enough parametric structure on the underlying problem that you can give an efficient solution. Yeah?
So you said that if you submit your 50,000 shares and they don't trade in one time step, that you haven't got anything in return. Well, but you haven't cost you very much either, right? You just submitted them, they came back to you, and you could say they're like they didn't get consumed. The process of making one of these stacks.
No, so for a
they
single
get
step,
consumed,
it's not a
that's
big
good,
deal. But
it's
if I'm sort of going for an efficient algorithm, I can't do that indefinitely, right, before I contemplate doing something else.
No, right, but the probes don't cost you too much.
Individual probes don't,
Yeah.
but I guess the high level point here is the number of probes I could make, right, is really exponential in the number of venues there are. And so I can't sort of solve this problem with traditional banded optimization where I try each allocation enough times that I get a good estimate. I need to somehow generalize across different allocations.
How many time steps are there in a day? One of these ones, roughly. I mean, 10 or 100, a million?
Well, I mean, that's kind of up to, well, I think it depends on the stock and it depends on the dark pool. But I don't think it probably, given the current liquidity of dark pools, it doesn't make sense to kind of keep re-pinging them on a millisecond time scale, right? Because there's not enough time for things to change there. There's still not even in a liquid stock like Microsoft, there's not nearly as much traffic. So your opportunities for kind of exploration are limited still. Yes?
But just to come back to the objective, is the reason you're trying to do this as fast as possible? Because the price doesn't depend on the speed, exactly, because the price is fixed in the mid price, whatever the lit market is at that time. But is the reason you're trying to do it fast because you want to limit the market risk if you're a broker? Or?
So it's a couple reasons. So usually the client that's giving the directive to buy or sell shares, they're not trying to get an improvement on the market price, but they have a model that tells them that broadly speaking, Microsoft is mispriced right now.
Right.
Okay, and they have some time scale on which they think that returns can be realized from that.
Yeah.
And they want the time it takes to get into the position to be small compared to the time over which their model predicts they will realize returns, right? So they come to the brokerage with a time constraint. They basically say to the brokerage, here's the position, here's the size of the position I want you to get for me, and here's how long you have to get me into it.
Yeah.
And it's usually, somewhere on the order of hours at the low end to days on the high end.
Okay.
But just to understand your model, you're assuming that these venue distributions are essentially fixed.
That's right.
And you're allowed to make essentially simultaneous allocations. It's like simultaneously pulling multiple arms of a bandit.
That's correct, right. So really the action space really is the cross product of your submissions to all of these, which is a very large space. But obviously it's not an arbitrary large space because slight modifications of a given allocation you assume should give you similar payoffs, right? And implicitly we're of course going to be exploiting that. Okay, so the main claim is that this algorithm I've been describing, where you sort of are in this very simple loop where you take your current distributional estimates, assume they're the truth, allocate according to those estimates, get new data, and then re-estimate. The simple allocate, re-estimate loop rapidly, by which I mean in polynomial time, converges to near optimal allocations. And one of the interesting things about this algorithm is that the exploration is kind of implicit. So you're never sort of deliberately saying, well, now let's try doing random things for a while just to explore a bigger part of the action space. The exploration actually comes even though we're always behaving optimally with respect to our current estimates. Yet somehow exploration, just the right amount of exploration occurs. And one of the things that this means is that it really could be that we never fully learn the probability distributions for some venues, or even for all of the venues. Okay, we learn just enough to behave optimally with respect to the order sizes that we need to deal with. Okay, so let me talk about the statistical subproblem of sort of estimating the distributions from the given observations. So let me kind of reframe this problem again, or remind you of this subproblem. So now let's go back to focusing on a single exchange, a single dark pool. And for that single dark pool, we have this probability distribution P of S, which is the probability that exactly S shares are available on the other side at a given time, time of submission. Okay, so we're going to observe for this venue a series of censored executions. At time t, we decide somehow to submit some number vt of shares, and some number actually gets executed that's less than v of t, right? Okay, so it could be up to our amount, but never more. Okay, so these are the censored observations. So now here's the natural question, which is if you have these censored observations, you know, and remember that there's sort of a strong non-IID aspect to this introduced by the fact that we have this control, right, which is the sequence V of t. But we can still ask the question, however we chose the sequence V of t, now we've made observations, what's the maximum likelihood estimate of the probability distribution P of S? Okay, so after spending a fair amount of time working this out, I of course discovered that this has been known since at least the 1940s in the statistics literature, or more accurately originally the biostatistics literature. And this is basically called the Kaplan-Meier estimator. And let me just, as a historical aside, tell you how this estimator comes up. So one way it comes up in biostatistics and survival analysis is you want to do a trial of a drug, okay, and come up with some estimate of the drug's effects on life expectancy. So you get a subject pool, right, and you pick half of them to give the experimental drug, and the other half, everybody has the disease. Half of them get the drug, half of them don't get the drug, or maybe they get a placebo. And then you want to see what the effects on survival time. Well, you need to publish, so you can't wait until everybody dies and look at the difference between the two distributions. You need to pick some point in time, like 5 years, and say, well, basically, the people who've died already, we know they're dead. The people who are still alive lived 5 years or longer from the introduction of the trial. So the analogy here is that submitting an order and getting back less than we submitted is like somebody that died. And submitting our order and getting all of the order executed is like somebody who's still alive at the 5-year mark. Okay, but so there's this Kaplan-Meier estimator, which basically gives you a closed form expression for exactly what the value of P of S should be for every value of S given your series of censored observations. If you go look on Wikipedia, for instance, at the formula for this estimator, it's completely mysterious what it's doing. But I'll tell you the version of it that I rediscovered that of course is equivalent because it's a rediscovery, which has a more algorithmic flavor. Basically what you do is you first take the uncensored observations. You take the observations where what you got was less than what you asked for. And you know that these are actually unbiased draws from the underlying distribution. And you first form the empirical distribution given by those uncensored observations. Now, a censored observation is basically like an observation that says the real value is somewhere to the right of this, okay? And so what you do is you now order those censored observations from highest to lowest, and you basically say, take the rightmost one, let's say it was 50,000 shares or greater. You basically take that one observation on 50,000 shares or greater and distribute it fractionally proportional to the current empirical distribution to the right of that point. And then you recurse in this way from right to left, okay? And this basically gives you the max likelihood estimator, which if you think about it, makes sense. Okay, so what's known about this Kaplan-Meier estimator, at least prior to our work, is that basically if you're making IID submissions, so if the V of t are actually IID, then you have asymptotic convergence. So if you draw, okay, and then you also need the V of t to be large, right? So if you really want to learn the entire distribution P all the way out into its tail, you have to first of all be submitting arbitrarily large orders. So you first of all, for this theorem to hold, you need a distribution over your submissions. That distribution must put support, some of its support, on beyond the support of P, so that you're making large enough submissions. And then if you do this infinitely often, you'll eventually learn the distribution, okay? So unfortunately, this theorem is inapplicable for us, right? Because we violate both the IID of the submissions, right? Because the submissions are changing in response to what our learning algorithm is doing. And we also want a finite time convergence result. But so we basically prove and use a stronger lemma, which I'm going to paraphrase here. The technical description of it, of course, is more technical. But I think it says something quite intuitive, which is the following. Suppose we look at any particular volume S. Okay, we look at some particular number of shares S, and we look at the gap, we look at the L1 distance between the true mass assigned to S and the mass that our estimate is assigning it. Let's call it p hat, under this Kaplan-Meier estimator. Okay? So basically, the claim is that the L1 distance between these two, the absolute difference between these two, will basically decay as 1 over square root of what I'm calling n of S, which is basically the number of times we submitted more than S shares to the venue. Okay, so it kind of makes sense. If lots of times I submitted more than 1,000 shares, you would expect that I might have good estimates for the prefix of the distribution up to 1,000 shares. Okay, I may not be able to say anything beyond 1,000 shares, but if many, many times I've submitted 1,000 shares or more, I should know about values 0 up to 999. Okay, and this theorem is basically quantifying that. And actually, this is one of these theorems that's or lemmas that's one, whose proof, right, is it's just a matter of once you kind of pick the right martingale, it becomes very, very easy. And if you don't pick the right martingale, it's impossible to see why it should be true. Okay, but so what this lemma really lets us do is, for the purposes of just the analysis, we can kind of define a cutoff, right? We can go to any one of the distributions, and we can basically say, well, let's pick some value of this gap that we're willing to tolerate. We're willing to allow our estimate and the true value on a given volume to be up to epsilon, okay? And then we can kind of define a cutoff, right? We can define a prefix of the distribution basically by setting epsilon equal to roughly this quantity, where we can assert that up to that point we have an epsilon good approximation of the distribution, and beyond that we don't know, okay? Okay, and this is just sort of showing some artificial simulations where there's an underlying true distribution. These are the blue noisy lines. The green is the actual Kaplan-Meier estimator on some amount of data from the algorithm that I'm describing, and you can see that indeed it's true that for all of these cases you have a pretty good approximation up to some point, and then the estimator is really just spreading its weight rather indiscriminately in the tail, and you don't have a good estimate in the tail. And so we might hypothetically define these cutoffs to be where these red lines are. Okay, so now I'll talk about how you pull this all together. So the algorithm is more or less as I've described, but I'll give a little pseudocode here. So you first initialize these estimated distributions P1 through Pk. Okay, first of all, by the way, notice that in order to make any kind of finite time or polynomial time statement here, I need there to be some maximum number of shares that could ever be available in any venue, right? So I can pick some very, very large number and say, well, there's never going to be more than these many shares available, because otherwise I just don't have a finitely parameterized problem, okay? But so given that I'm defining that sort of maximum available volume that could conceivably ever be executed, a reasonable way to initialize these distributions is just to have them be uniform over that entire interval, okay? Sort of say that all volumes are equally likely between 0 and V max, okay? Then I'm going to repeat this loop forever. I'm going to compute the optimal allocations to the venues given these distributions, assuming that they're the truth. I do this offline optimization allocation. Then I'm going to go ahead and submit those volumes. I get back another round of data for each venue, and then I'm going to re-estimate these distributions with that new data point. And I'm going to use the Kaplan-Meier estimator, but it turns out to make this work, I need to just define a slight modification of the Kaplan-Meier estimator, which I call the optimistic Kaplan-Meier estimator. And basically what the optimistic Kaplan-Meier estimator does compared to the original one is just take a very, very small amount of mass and move it out to the tail of the distribution. And it turns out that by doing that, that's just enough of a tweak to the estimator to actually give you this implicit exploration that I described before. Because by doing that, right, you're slightly encouraging the algorithm to think that there might be mass out there and cause it to explore out there. Okay? And so here's how the analysis, which ends up being quite clean, works. So let's go through an easy case first. So remember I defined this notion on the last slide of defining a cutoff value for each venue, where we sort of for a given value of epsilon, we've defined, we sort of have picked a cutoff so that we can quantify how good our approximation is in that prefix of the distribution. Okay. So let me call those cutoffs the C sub I for each exchange I. So if in a given round, the allocation that I compute happens to have the property that the volume that I submit to every venue is below whatever the cutoff is for that venue at that time, then intuitively, on this, at least on this individual step, I should do well, right? Because I knew my algorithm used these estimates and came back and told me, well, given these estimates, you should submit this many shares to each pool, and every one of those values was in the prefix of the distribution that we claim we have a very good approximation for. So it's almost as if we do know the truth with respect to this particular allocation. So sure enough, you can prove that if this condition holds, then on this step, we'll actually make a near optimal allocation. Okay? So if that doesn't happen, there is only one logical alternative. It means that in at least one of the pools, let's call it pool J, the volume that we submitted was greater than the cutoff for that value. We submitted a volume that was out in the part of the distribution that we can't assert we have a good approximation for. But that's a good thing too, right? Because every time we do that, we'll get another data point in a region where we must have had little data before, because otherwise we would have had a good approximation out there. And so we'll improve our estimate of P sub j. And so you can see that this can only happen so many times, right? Because every time step that we fail to do a near optimal allocation, we're getting another step of exploration. And in a given venue, this can't happen an unbounded number of times, because eventually we keep moving the cutoff further and further out on the tail, and the worst that happens is it ends up with us actually learning a good approximation to the entire distribution. Okay? And for those of you that really know the reinforcement learning literature, there's a sort of strong analogy not just to reinforcement learning, but to a particular family of algorithms for solving the exploitation trade-off in Markov decision processes that goes by the name of E-cubed or R-max algorithms. Okay, so the main theorem is an algorithm that efficiently converges to near optimal. The version I've been describing to you, by the way, assumes a non-parametric setting, by which I mean each probability distribution is sort of an arbitrary distribution which says, well, you know, there's a certain probability on 1 shares, 2 shares, 3 shares, so on and so forth. In reality, of course, it's quite natural to look for parametric forms to that distribution. And in particular, it wouldn't surprise you if I told you that if you looked at real data and tried to fit a parametric form, the best parametric form we could find to actual dark pool execution data was one where you have basically 2 parameters. You have a single parameter which says what's the frequency or probability with which there will be 0 shares available for you. And that number in most dark pools is quite large. So your experience in most dark pools most of the time will be you go there and there's nobody to trade with. Okay? So you want to make sort of a special bin or parameter for 0 shares. But then on the positive part, it's basically a power law. You can approximate it well by sort of a heavy-tailed power law fit. And so that gives you your second parameter, which is the exponent of the power law. And so if you have such a parametric version, instead of the running time of this algorithm being kind of the number of bins in each distribution, you can have it just be kind of 2 times the number of dark pools. Okay? And so we're kind of in the medium case that I described. I'll stop here. I more or less finished the first vignette, but not the second one. But I'm happy to, people that are interested in finance, I'm happy to talk. And maybe I'll just, if you want to go see, we have some empirical validation of this algorithm on actual dark pool data that you can go look at in the paper. And I'll just mention that one of the things I'm interested in thinking about while I'm here, and I've been already talking to Anton and to Peter a little bit about it, are sort of importing ideas from algorithmic trading and quantitative finance to sponsored search problems, to ad auction problems. So in particular, another very common algorithmic problem in quantitative finance is designing an algorithm that for a given volume of trade that you want to execute and a given time period over which you execute it comes as close as possible to executing that trade at the volume-weighted average price, the so-called VWAP, of the period in question. So you basically can look at every trade that actually happens and say, well, you know, here was 100 shares for this amount, 1,000 shares for this amount, and just compute the volume-weighted average price over the day in question. And then the goal of the algorithm is to try to buy a certain number of shares of the stock, getting a price, and a price per share that's as close as possible to that volume weighted average price. So the analogous sponsored search problem would be to say to advertisers, instead of what you currently do, or what all the major search engines do, they basically say, well, if you give us a budget, we promise to try to spend it. And that's about it, right? So that's the analogy on Wall Street would be a brokerage saying to a hedge fund client, you want to buy 1 million shares of Microsoft stock? I'll be sure to do it by the end of today. No guarantee on the relationship between the prices that the hedge fund gets and the price that the market was trading at. So this is a non-starter on Wall Street. The hedge fund would laugh at the brokerage. The brokerage promises not only will I get you the shares, they won't be too far from what the market price was. So the analogy in sponsored search would be not only will I spend your budget, but if you look at the price per click that you paid in my consumption of your budget, it's very close to what the average price per click was over the period in question. And so that's sort of a problem that you can kind of directly lift from finance and ask in a sponsored search setting, and it would seem to me not at all implausible that you might find that advertisers would like such a service and might even someday demand such a service. And so I'll stop there and take questions if there are any.
Just given the time, a couple of quick questions. Oh, please.
So it looks, if we take the multi-agent perspective on the dark pool problem, it looks like there's a coordination problem, and if there was only one pool, everyone would be better off.
Okay, you ask a very interesting question that's not even specific to dark pools, but any kind of exchange, right? So given that we're in this era where we've moved away from there being a single centralized exchange that by law everybody must trade in, like NYSE or NASDAQ, you have all these exchanges. And Ramesh Johari at Stanford and I have talked, and I think he's done a little work on, you can ask this interesting game theoretic question. One of the advantages of having multiple exchanges, even from the trader's perspective, is competition, right? So if there's only one dark pool, the dark pool can kind of, set its fees any way it wants. If there's a few dark pools, then there's competition for what the fees that they charge are, okay? On the other hand, if there's too many of them, then we might have this coordination or liquidity fragmentation problem where we just can't coordinate on which one to go to, right? And even if we could, it would then drive the other ones out of business because they're not getting any business. So you can even imagine phrasing this as a game theoretic problem, which is, given some model of how competition reduces fees for the traders, what's kind of the optimal number of exchanges and what's the distribution of liquidity across those exchanges in equilibrium. And I think there's been a little bit of work on this, but I don't know a specific pointer.
So I have two questions. One question relates to the actual expectation on the number of time steps that you would need to actually satisfy all the executions under the model, because the baseline would be just the number of dark pools. So if you have 5 dark pools, you can just sequentially go through them, and eventually your execution would satisfy, if it could be satisfied.
So this algorithm will be much, much more efficient than that algorithm, especially in the case that you don't need to sort of explore the tails of all of the distributions in order to find optimal allocations on average. So there are limiting cases where, despite I think the sort of superior aesthetic of this algorithm, there are cases where it won't do much better than what you described, sort of sequentially learning each dark pool all the way into its tail, and then now you know everything and just do the offline allocations.
Even the allocation, you can have the sequential allocation is bounded by the number of time steps required for the sequential allocation is bounded by the number of dark pools. For example, if there are only 2 dark pools, you just go to first, go to the second one, and you're done.
So like even with 2 dark pools, right? I can really give you 2 different distributions where you want to split your order. You really need to split your order to get optimal behavior, right? You really, in other words, I can give you a dark pool where if you submit, if you have 1,000 shares, If you submit 500 to each of them, with probability 1, you'll get all 1,000 shares executed. If you submit 1,000 to one of them, you'll have 0 chance of getting all of them executed. So it's not sort of going to 2 distributions doesn't radically simplify the problem. Going to 1 does, but not to 2.
And the second question is that you actually mentioned the execution risk and the actual
Position risk, yeah.
And the position risk. So, I mean, if actually traders and the brokerage houses, they actually make money by trading this sort of risk, and I would be surprised if they do not actually have a trade-off between the execution risk and the position risk.
Okay, so once again, you've put your finger on an extremely contentious issue on Wall Street, which is the extent to which brokerages, by which I mean the traditional definition of brokerage, meaning providing execution services of the kind that I'm describing, and the risk-taking, the position-taking side of things, to what extent should they be separated? And so, for instance, right now, it is illegal for, and I know this because I did this kind of thing at Lehman Brothers and later at Bank of America, which the place I'm at now is a pure hedge fund, right? It doesn't have a brokerage business, right? It's just a pure hedge fund. But at Bank of America and Lehman Brothers, right, in the same organization, you have both a brokerage, very large brokerage services, and you had groups like mine, which were really, quant hedge funds within a large investment bank. By SEC law, by SEC regulations and law, we are not allowed to fraternize too much with the people who are in the brokerage business, and more importantly, we are never allowed to see customer trading data of the business. But it's a slippery slope. And it's a slippery slope in the sense that there are many reasons why you as a client of a brokerage might want them to be allowed to take risk. So, let me, just to go down this slippery slope because it's somewhat interesting. So one thing that I very much might want my brokerage to do is what's known as internal crossing, meaning that instead of every time I send an order to them, they're immediately sending it to the exchanges, holding it for a little while to see if there's another customer of the brokerage that basically, you could execute the trade against, and basically not pay the exchange fees, okay? And then maybe the brokerage would say, well, I'm going to take a little bit of the exchange fee that you would have paid, and I'm going to give some of it back to each of you, and everybody's happy, okay? So now, if you might want that, right? Well, you might want to, maybe now they have a model that says, well, look, right this second there isn't a counterparty for you, but I know from my historical data that there will be very, very soon. So why don't you just let me be your counterparty for now, and then I'll execute against the counterparty when they arrive later, okay? Now I'm taking a little position risk, right? And now I might want to now if you let me do that, I might want to decide, my quant model actually tells me that this is a good position to keep long term. And so now I'm just going to be your counterparty. And now I'm a hedge fund. Now I'm a pure hedge fund. And so in my experience, and I was part of a group where this happened, right? They basically, at some point they said, there's too much overlap between sort of brokerage and position activity here. And they sent one of us up to the 8th floor, and they sent the other group down to the 2nd floor. And I was with the group that was pure prop trading, position risk. And sure enough, within 2 years, the guys that were sent down to do the pure brokerage activity had sort of regrown a prop trading head because it's profitable. It's profitable, right? And in many cases, it's actually profitable for your clients as well. But then suddenly you're able to take risk, and you see all of your clients' trading data. So there's now, of course, endless opportunities for abuse as well.
I guess we could, we should.
Or people can just leave, if they need to, yeah. Okay, thanks.